Tony and Morgan, our first question, I think that a lot of people are really concerned about, with everything that's going on with COVID, with the supply chain. We're hearing about the effects of inflation. So we'd love to hear both of your insights, on what it is. Tony, why don't you start out?
Yeah, so inflation has become a big concern. Not a huge concern, but certainly something that I think is pretty much on the radar of all the investment managers that are out there. As you come out of a crisis like we went through with the pandemic, global growth tends to, you're coming off a rock bottom, so growth tends to look quite magnified relative to what the norms are that we're really used to seeing. And with that, there comes price pressures, production pressures, manufacturing pressures, and things like that. So the inflation that we see, I would say, is mostly normal. That has to do with just the general economic recovery that we're seeing over. It's going to take place over a number of years after the shutdown. But I don't know if you pay attention to, some of the news that's out there, the original conversations where it should be transitory. We'll go through this. Things look inflated. They should start to come back. I think that's true for the most part, but I think that there's an opportunity here that we may see higher levels of inflation than what we've seen in the past. I wouldn't say skyrocketing levels, and I probably wouldn't categorize it as scary levels, but the supply chain has been disrupted, and that's really important. Just in a nutshell, we have companies that are used to having just-in-time inventory, so when you buy something, they just keep enough to make sure that you can get what you purchase. That's been beneficial to a lot of consumers because that money, the costs that go into storing those goods, has been able to be saved because they're practicing that just-in-time inventory. Our fear in the near term is that companies are going to adjust their inventory storage practices so that just-in-time may have to be augmented, but if that gets augmented, there'll be more embedded costs because people have to pay for storage. They'll be rethinking the supply chains. People will be coming back to work, and so that's going to put more. Until then, there's capacity constraints. There's all kinds of different limitations that we're seeing with the supply chain. So at the end of the day, inflation is inflated. No pun intended there, but it's high. I think you've seen it if you've tried to do any work on your house, or you've tried to, if you've gone shopping for cars, those types of things. Some of those pressures will be alleviated. It won't be I don't think it'll be anytime soon. It'll start to some of those pressures will start to wane here in the next 6 to 12 months. But I think that inflation could be something that we'll learn to live with, but I don't think it'll be excessive.
Do you want to add anything else?
Yeah, sure. I'll add a little bit. I'd say we generally would agree on this topic. From Horizon's perspective, what we're seeing from inflation, as Adam mentioned and Tony, around these supply chain bottlenecks, and really what's happened. If we think back, going back over the past year and a half, we had this economic shutdown where production basically came to a halt, and you did not have the same capacity that we typically had. However, demand for goods, right? As you mentioned, anyone that's done anything for their homes, I purchased a home in 2020 and renovated it, and it was a difficult process, I would say, to say the least, to try to get anything in time, and trying to get supplies, things like that. Everything was backed up pretty significantly, right? And if we think about it, from an income standpoint, generally, people were either able to go back and keep their jobs but work from home, or on the other side of things, there was that government assistance, the extended unemployment benefits that really did help people, maintain their spending levels. The difficult part was, people were able to spend money, but there were no services to spend it on, right? We weren't going out to dinner. We weren't going out to events. We were spending money on goods. And so when all of that money, so everybody had the same amount of income in aggregate in this time period, but we were all spending it on goods. And to Tony's point, the supply chain just could not sustain that and did not expect that demand to really keep up over a long period of time. I would say, in our view, these supply chain bottlenecks, they tend to work themselves out over time. What's the cure for high prices? Generally, it's high prices. Anyone that's been trying to purchase a home over the past year may have seen the craziness in the market and said, okay, I can wait. I'm going to wait for prices to abate. And that's kind of where we see things going at Horizon. We should expect inflation probably over the next year or so to remain at these higher levels. And then we think it'll tick back down higher than we experienced in the past, probably around 2.5%, where historically it's been around 2%. But we would agree. It's a concern right now, but I don't think it's overly concerning. It's not, the stagflation that we experienced in previous decades.
And to keep along with the inflation, both Tony and Morgan, are you guys making any adjustments to your portfolios in the short term and the long term based on those inflation concerns?
The best way to address inflation is the equities are the best hedge for inflation. Now, are we tilting towards equities? No, not necessarily. We like in our portfolios, we have a little bit of an equity overweight, but it's not. It's only a couple percent. And so big picture, equities is the best inflation hedge. Bonds don't do really well when you're looking at inflationary pressures. Usually what happens is with inflationary pressures, your bond yields tend to follow growth. So if you have strong economic growth, which we're seeing here globally as we rebound, inflationary pressures tend to be there, then your bond yields tend to go up. So how much you get out of your fixed income portfolio, that yield goes up, and then consequently the price of your bonds go down. So they're not a very good hedge. So are we changing our portfolios to compensate for that? I wouldn't say directly. We do have the equity overweight, but we also, I think more directly or indirectly, we emphasize things like infrastructure and real assets. So the real, if you're during the shutdown, real estate really, it got hurt and then really failed to keep up with the equity markets. And so if you look at our portfolios, we've got a little bit of an emphasis on real estate as well as infrastructure. And there's a pending infrastructure bill and things like that. But with the economic recovery and as we try to crawl out of it, infrastructure should be an area that can take advantage of not only the increased spending that we do, but that will lead to increased inflation. So it's a little bit of an indirect play.
Yeah, I would agree that equities or the stock market is generally your best hedge against inflation. Fixed income is going to be very difficult to keep pace, especially with where interest rates are currently. So at Horizon, what we're looking into is, how do we look at maybe different strategies that give you historical returns that are similar to fixed income, knowing that in the future, we're probably not going to get those same bond returns that maybe we had before. So we're doing a lot of research on that end of just trying to find strategies where we don't want to, go to Tony's point, taking a slight overweight to stocks makes sense, but also you don't want to change your risk tolerance, right? You don't want to get overly aggressive just trying to play or trying to make sure that you're outpacing inflation, because when markets do sell off, you don't want to be in the incorrect portfolio. That's not appropriate for you, right?
Yeah, thank you so much. And the thing that we hope you get out of this is really, from the vantage point, if, there's a lot of concerns out there, the thing, we go back to goals, plans, and investments, right? Thinking your long-term goals. And there's a lot of noise out there in the inflation. And we would even say, if inflation is 3 years, right? For many of us, the planning that we're doing here is 30 plus years that we have to do it. So it's not that we're very, very casual about those types of things, but it's taking a longer term investment or investment horizon. And, like Morgan and Tony had talked about, what's really, really important to remember is that there is no better long-term hedge on inflation than stocks. Bryce and I saw something that really floored us. So in 1980, the Dow Jones was 800. The price of gold was 800. 41 years later, the price of gold was around 1,700. So it's gone up about 2.2 times since 1980. And many of us, and I'm going to ask this to Tony and Morgan about their outlook on gold, cryptocurrencies, things along those lines. But the Dow Jones has been up to 35,000. So when you think about just that stocks are owning the best companies, which many of you do, you own the best companies not only in the United States but in the world. They've gone up over 40 times, whereas gold has gone up 2 times. So we hear a lot of things about gold as a good inflation hedge, but owning companies is the best long-term hedge. To go along with that, Tony and Morgan, the folks, as they hear media sources, go on the internet, watch television, there's a lot of people, buy gold, buy cryptocurrencies. How do you guys advise your clients on that?
Gold for us is not necessarily a holding that we would have long term. To Adam's point there, it has been an inflation hedge, but it's not a perfect inflation hedge. There have been very many periods where gold has not provided that same price increase that maybe we've seen, or that you may have hoped, or we still would agree that equities are the best place to go there. So gold is difficult because yes, it has a nice store of value, but it doesn't provide you any income. You're not owning anything. It's just what is that price of gold going to do? And it can be rather volatile too. So you can have a lot of price increases and decreases in gold.
So really echo all the same comments. And really when you have gold as an investment, it comes down to your tolerance for volatility and risk. And so we don't use them in our portfolios here, but we have institutional clients that have allocations to gold, and they have the wherewithal. They have infinite time horizons. So that's one of the advantages of an institution is, like one of our clients, like University of Alabama, it's going to be around forever. They're not on a finite timeline like the rest of us. So if you have the time to take on that level of volatility, you can do that, but we don't use it in our portfolios, but just really because it is very volatile. It is a storage of value. When you get into cryptocurrencies, that's one of the things that's lacking with the cryptocurrencies. We don't actively invest with cryptocurrencies. We certainly understand it, but I think there's a long way to go before those are really sort of what we would call institutionally accepted. So there's a lot of interest, but most of the institutions they have an interest, but they're not really biting just yet on the cryptocurrencies. And if you look at the volatility and how volatile they are, they're upwards of 3 times how volatile gold is, or 4 times relative to stock equities. And what that usually tends to indicate is there's a lot of unknown risks that are going there. The cryptocurrencies have been nice because they're spurring new technologies. So like the blockchain technology, that's something that I think if we were to roll forward the clock a decade or two, you're going to see a lot more blockchain type of technologies in other aspects. So cryptocurrencies is the first area that we're seeing the blockchain technology, but anything with a transaction could have a blockchain backbone. Just a more efficient way of protecting those that participate in transactions.
Just to follow up on the cryptocurrencies or Bitcoin, would absolutely agree there. It's still very early in the game. There is a lot of really interesting technology, the blockchain technology, that can basically make the transaction process a lot smoother and more efficient. But as an asset to invest in, to his point, it's extremely volatile. I think Bitcoin, for example, which is the most prominent kind of cryptocurrency out there, it traded at, I believe, $60,000 earlier this year, and at another point, it was at about $30,000. So that's a 50% sell-off in the asset, and that is not uncommon at all in cryptocurrencies. And I don't know about you guys, but I'm probably not going to hold something that has a chance to sell off 50% every year. So that is something that we would say is still in the very early innings right now.
Yeah, thank you so much for those responses. I mean, to add what we're communicating at Harford Financial Group, gold, like Morgan and Tony said, it can be a good hedge at certain period of times. one of the things we want to really communicate, there is no perfect investment. There's no investment that is 100% effective 100% of the time. They go through cycles and waves when something is in and something is out. The way I would want you to think about cryptocurrencies or Bitcoin specifically, the key thing that you need to realize is it's not regulated right now. So many of the investments that many of you have here, it's regulated by the government. There's a lot of oversight from the Securities and Exchange Commission, the SEC, the IRS, the Department of Labor for the types of accounts that many of you have. That with Bitcoin, there's not that regulation. And so I often use that analogy of, when you go to the beach, right? From 10 to 5, you got the lifeguard watching you and so on. You can swim in the ocean. You start having struggle, they'll come out. You can invest in Bitcoin in a lot of the different things, but that's like after 5 o'clock when they move their lifeguard in. You can do it, but you have to know what you're doing on there and understand the things that you have. And the other analogy that I would give to you is that ultimately, Tony and Morgan are talking about the blockchain. We know that in the COVID time, we're paying more electronically. We're using Visa, we're using cashless, sort of transactions. That is the wave of the future. But if you go back to 1990s, many of us that were in here, we knew that the internet was changing, but we didn't know Google was at the time. Who had an AOL account, right? Yahoo and all those things. They were the guys that were on. You don't know who the ultimate thing. Bitcoin is just one cryptocurrency. So we don't know who the ultimate winner could, be on that. One of the things we've talked a lot about stocks and investing in the best companies and so on. So, we'd love to hear some of your outlooks on, is the stock market overvalued? What are the opportunities? How should we think of it in the long term?
So when we look at the stock market today, specifically in the United States, stocks are expensive right now. So if you look at it from different valuation metrics, right? So how much are you paying for each company? They certainly are expensive. They're not, in our view, we're not in the same dot-com bubble that we saw in the 2000s. We think that it's important when you're looking at, where am I going to invest? You shouldn't strictly look at the stock market, right, and say, I'll either invest in the stock market or I won't, right? To Adam's point in the long-term bucket that you have, you're probably always going to want that exposure for your long-term money. But what's important to look at from an expense standpoint is to say, where do I invest that next dollar? And when we look at different asset classes, so say you look at stocks and then you look at bonds, if you look at bonds, interest rates, we all know where they're at. They're very, very low right now, right? Which is, great if you're taking out debt, but it's certainly not great if you're investing in fixed income or bonds. So if bonds are not paying that same income that maybe you historically have been used to, in our view, that would actually make bonds expensive because you're not getting paid to hold that same asset that maybe you had previously. If bonds are expensive, that actually makes stocks slightly more attractive in our view. So while stocks right now maybe look expensive relative to their own history, if you're looking at where do I invest that next dollar, we would still tilt towards stocks in that regard because the other option is just not as attractive.
Yeah, that's pretty spot on as a description. Stocks are pretty expensive. When you look at relative to other asset classes, they're relatively attractive, specifically bonds. So that's sort of it's kind of the dilemma when you look to invest. But there's other elements that are going on. So stocks are very expensive because interest rates are very low. We're coming up on a period now where economic growth globally is near 5%. So what'll happen is, and you're starting to see it's going to start happening next month. I guess that's next week, right? So the Fed's going to start to pull back the amount of quantitative easing that it's been doing. So you're going to hear words like Fed tapering and things, and all that means is they're buying less bonds. When you buy less bonds, you do that because the economy is growing quickly, and when you buy less bonds, that's less buying pressure on the bonds, and so yields are going to go up a little bit. So you're going to see interest rates potentially go up. And the idea there is it helps to cool off how quickly the economy is growing. But there is a a lot of room to go with interest rates. I think over the next couple years, there's an expectation that the Fed will raise rates a few times. Over the next 3 years, there's an expectation that the Fed's going to raise rates 5 times. So when you put that together with the tapering that will be in the news, there's a real potential for the interest rates to go up. And as that happens, that could be a good thing because the market can stand on its own 2 feet. It doesn't have to have all of the monetary and fiscal policy that we've been seeing. So the economy has an opportunity in the market to stand on its own 2 feet. But what that'll mean is we do have higher levels of interest rates. And so what that'll do is on a relative basis, that will make bonds more attractive relative to stocks. Stocks, just real quick, stocks get valued. The higher the interest rates go, stocks tend to be cheaper. If you lower the interest rate, stocks get more expensive. So as interest rates go up over the next several years, if we can continue our economic growth, then on a relative basis, we're going to potentially be in a period where bonds could be much more potentially attractive than equities.
Yeah, so we had a lot of questions, and I know just in the essence of time, we're probably not going to get through those, but I know some of the things that are on top of folks' mind, Tony and Morgan, is a lot, as a response to COVID, and then Michael brought up our spending for the country went up 47%. Long-term, deficits, debt, all those types of things, reserve currency for the dollar. What's your long-term outlook, and how should we as investors think about that?
COVID's a big curveball. And if we could get back to normal conditions, think about how the supply chain is affected, just every aspect of how we get goods. First off, all the goods that come from China, for example. And we think about the manufacturing facilities and people, the COVID protocols that keep the same number of people coming to the factories because of social distancing and things like that. It keeps the facilities, the manufacturing facilities, it keeps them from being able to operate at their full capacity. And then we've got right now stimulus measures that are keeping people from going back into the labor force, participating in jobs. At some point we will become more normal. I think that will happen, but it's going to take a long time to fix. The supply chains are really broken right now. You're starting to see raw materials come in a little quicker than they were. So we're starting to see an uptake. So that's the first part of it, right? And then finished goods, goods that are in process, those are still lagging behind. But there's a light at the end of the tunnel for us to get back to work, get our production facilities up. China's, unfortunately, they're sort of at the beginning of all of this, simply because they manufacture a lot of goods to us, and because demand was so strong, they have power outages all over China. They can't make enough power to be able to fuel the factories that make all the goods that we want. So I think it's slowly being repaired. They're now working 24/7 to unload all of the ships, the tankers that are out off the coasts. But that's going to come at a cost. We have to pay workers to do that. So we're going to see that residual inflation persist for quite a while. But I'd like to think there's a world where we start to get back to normal.
I wouldn't have too much more to add to that. I would absolutely agree with what Tony said there. We are getting back closer to normal kind of pace here. I think what's also important to know, I know this always seems to come back to inflation nowadays, but when we say that inflation is probably going to slow down, at least I'll speak for myself, we're not predicting that prices are going to drop back down to previous levels, right? Prices are going to continue to rise, just at a slower pace. So it's not, lumber companies are not going to go back and say, okay, you just spent $6 on a 2x4, we're not going to go back down to $2, right? So those prices are just going to start to move up at a slower pace as we go forward. That's only thing I would add on that end. And then in regards to, the amount of debt that has been kind of pushed out into the system, what's the long-term ramification of that? Honestly, we don't know at this point. It doesn't seem like we can, necessarily print a few $1 trillion a year and have no effect, broadly speaking. In our view right now, it seems to, outside of some of the inflationary kind of indirectly causing inflation through the demand that has sustained itself, that certainly has played a role. But long term, it's still up in the air on what that effect really will be. We still do believe that the U.S. currency is still going to remain the reserve currency globally. We believe that the faith and kind of backing of the U.S. government, it's still kind of the gold standard across the world, and we don't see that changing for quite some time. There's no other place where you're going to get that same liquidity than in kind of U.S. government bonds.
Yeah, thank you. We'll close out. We have a couple questions left, and the first one is there's a big push for what is called ESG, environmental, social, governance types of investing. What is your firm's sort of outlook on that, and how could that potentially be used in portfolios for our clients?
We do a lot with ESG investing, and really, it's more of a tailored approach to the client. So it really depends. And that's a big umbrella. So that can be anything from like the Sierra Club and the environmental concerns to, say, a Catholic organization that's really more worried about USCCB guidelines and what they buy and the restrictions. So that's a big umbrella. There has been an increased, certainly an increased level of interest with ESG, responsible investing across the board. So definitely much more and more interest. As far as the implementation of responsible investing initiatives, I think that that's still lagging behind. I think it will catch on, but I think that a lot of organizations and people, for that matter, are really trying to understand what it means to them. What's that opportunity set look for them from an investment perspective, and then how can it be, what can they do with their own portfolio to be able to take advantage of responsible investing?
Yeah, I would agree with that as well. ESG, the environmental, social governance, kind of impact investing, certainly has some very attractive qualities, right? If you think about it, you're trying to avoid companies that may be involved in some, fraudulent or shady activities, or they just might not be doing, maybe they're putting their best foot forward. And that tends to be sort of a screen investment-wise towards just high-quality companies. So we do think that certainly is an attractive piece and something we have been looking into pretty wholeheartedly, forward-looking. To Tony's point, it's still pretty early on in the ESG world in regards to reporting. This is, not everybody has been forced to require or to report on all of these different requirements when it comes to carbon emissions. That's still in the very early innings. But we do think as we look forward, the more information you can get on how responsible a company is being is certainly important, because that a sustainably run company generally is going to have some long legs going forward.
Good. Yeah, and it's something that we're really looking into, because basically on the feedback that we've gotten from many of you, it's, hey, we really want to be socially responsible. We really want to look into things. So we're working with firms like Tony's and Morgan's to really better explore it. And as they said, it's at the beginning stages, and there's a lot of work to be done. To really sort of close this out, and I guess one of the things that, as you look at, aren't these some smart guys? They're really smart guys, and part of the thing is you don't have to get down in the weeds on that. We just want to help you, reassure you, we're working with some really top-notch professionals to have a worldview. And as folks are sitting out here right now, Tony and Morgan, they're wondering, well, how does this relevant for me? I'm invested in stocks and bonds, for an allocation to help me with retirement income, with estate planning, all those different things. If you guys could give us sort of a flavor of your firm's outlook, should we be making big changes and all those different things? How should we look at the world, as an investor?
So, the short answer is no, don't make big changes. You've got a great team here with Harford Financial Group, and they're doing the heavy lifting with regards to the planning process. So they're on top of the key issues, and it's your life situation that's going to affect your plan, right? We just fill in the gaps. Adam's very kind in talking about how smart we are, and sometimes I'm better looking I am. I'm just kidding. No, it,
Don't talk to our kids.
yeah. No, he's very kind, and we're very appreciative of our relationship. But really, Harford Financial Group is doing the heavy lifting, and to make sure that you're on the right path with your plan. And what we do is we manage according to the plan, and we don't make a lot of big shifts. If there's going to be a big shift, Harford Financial Group will advise that, and we're there to fill in the gaps.
Yeah, would absolutely agree there. I would say, the most important kind of investment decision generally that you make is nothing. Is to understand the risks that are going on in the world, but not to make any drastic changes because there's something going on in China. Let's go change our allocation there. Understanding your long-term time horizon is extremely important. We are going to try to understand the risks that are going on in markets and work with Harford's team, and they're the ones that are going to make the tweaks to understand, like, hey, this is where we need to make sure that you're aligned with your long-term goals. But absolutely, you guys are all in great hands here with Harford. They know exactly what they're doing. They've been wonderful to work with on our end. So I don't think there's anything drastically we would say from a change standpoint that we'd recommend.
Well, thank you so much. Let's give a round of applause to Morgan and Tony.